This is Barry Zalma on insurance. Today I'd like to speak about policy provisions to control moral hazards, a part of the essential requirements on the underwriter who is asked to accept a potential risk of loss. Policy provisions can be used to control the risk of moral hazard without refusing the risk in its entirety. Built-in provisions of the policy, like the fraud and misrepresentation conditions, work to deter losses by persons with a potential moral hazard. The standard fire policy and most first-party policies provide that the entire policy is void if the applicant commits fraud in securing the policy, or if the insured willfully misrepresents or conceals any material fact or circumstance concerning insurance. If the policy is a marine policy, the insured is required to volunteer material information even if not asked. With other types of insurance, the onus is on the insurer to ask the right questions. Failure to ask can compel an insurer to stay on a risk it would never have taken if it knew the truth. Recently, the state of California, near the end of 2021, enacted a law that made it a crime in California to misrepresent a material fact on an application. So that now becomes part of the required investigation of every claim and also is a deterrent to the moral hazard. There are other safeguards that insurers can implement to help protect themselves from the risks of moral hazard, such as the following. Title. The exact title to real property must be revealed to the insurer, including any encumbrances such as a mortgage, a note, or lease secured by a filing with the Secretary of State called a UCC or Uniform Commercial Code 1 form, or any other evidence of debt. The policy may not be assigned to a new purchaser of the property without the written consent of the insurer, since every first-party insurance policy that prevents against the loss to real or personal property is a contract of personal indemnity, not a contract protecting the property or insuring the property. It insures the people. And so a new owner is a completely different risk. To do so would deprive the insurer of its right to select whom it will or will not insure. Then there is the contractual right to cancel a policy. The insurer retains the right to cancel coverage. However, recent consumer-oriented legislation has effectively eliminated this option after a policy is in effect for 60 days, except for non-payment of premium or fraud. This legislation means that pre-risk inspection and post-loss reports are even more important to the underwriter. Prompt reporting of a loss. This requirement in a policy is designed to deprive the insured of the opportunity to organize evidence to appear honest, and requires that any loss be reported immediately and at the very least as soon as reasonably practical. Settlement of losses is also a deterrent to a moral hazard because the insurer, by a contractual condition, retains the right to repair the damaged property, which of course takes the profit out of any potential claim and puts it back into the property without causing any damage to the insurer. If there's a concern about a moral hazard, the underwriter has the right to include extra exclusions or special limitations by endorsement to standard forms. Certain property like money, gold, and jewelry may be excluded or may have special limitations placed on it to limit the insurer's exposure to a fraudulent loss. A condition dealing with increase of hazard also provides a deterrent to a person who may express a moral hazard and wish to try to defraud the insurer. This policy provision provides that no coverage exists if the insured does something to increase the hazard before the loss. For example, if a tuna fish cannery, without informing its insurer, decides to change its function to the manufacture of plastic explosives and nitroglycerin, this significant increase of hazard would clearly not be covered. In Dynasty versus Princeton Insurance Company, a 2000 decision of the New Jersey Supreme Court found that an insured who unjustifiably disabled a sprinkler system so as to increase the hazard faced by the insurer, that the fire insurance coverage was suspended. It also found that the increase of hazard clause is standard language required by statute. The Supreme Court, defining the terms, stated, quote, "An increase in hazard takes place when a new use is made of the insured property or when its physical condition is changed from that which existed when the policy was written, and the new use or changed condition increases the risk consumed by the insurer. An increase of hazard will generally not be found if there has been merely a casual change of a temporary character. Thus, the negligence of the insured does not constitute an increase in the hazard unless that negligence results in a change of some duration of the structure, use, or occupancy of the premises." Close quote. Of course, the reason people buy insurance is to protect against their own negligence. And a negligently operated business that accidentally causes a fire at the premises would be perfectly covered. However, if the business was set up in such a way that no matter what, a fire would occur because of the way the business was set up, then that increase in hazard would cause difficulty with regard to a claim, such as shutting off the sprinkler systems. The court concluded that the insured intentionally disabled the sprinkler system when he permanently placed the control of the sprinkler system in the off position. This increased the hazard faced by the property, sufficient to compel suspension of the insurance during the period the sprinkler was disabled. I once dealt with a claim where the insureds, to cause a loss, tied a rope around a sprinkler head in their factory directly under their inventory and pulled it out, causing an extreme flow of water onto the inventory, which basically destroyed the inventory. The eventual result of that case was, once it was proved, the claim was denied, the insureds were indicted, and escaped the country to avoid trial. But they collected nothing from their insurance company. The increased risk exclusion is not based on an insurer's knowledge of the risk, but rather whether the insured's actions increased the risk. Because that's what insurance is all about. It insures against risks of loss. It doesn't insure property. Moving a house to a different physical location was clearly a hazard within the control or knowledge of the insured. The district court properly determined that such an action so obviously increases the risk of hazard that it would be an inappropriate question for a jury to decide. This was a 2012 decision of the Minnesota Court of Appeal called Paul v. Holmgren. The Tennessee Supreme Court concluded that commencement of foreclosure proceedings does not constitute an increase in hazard under the terms of the insurance policy, and that no notice was required to be given to the insurance company. This was a 2009 decision of the Tennessee Supreme Court called U.S. Bank v. Tennessee Farmers. The term substantial change or increase in hazard has been defined as a risk that an insurance company could not have reasonably been presumed to have contracted for when the policy was written. When undisputed facts presented to a court were that the insurer canceled the policy because the insurer concluded that a substantial increase in hazard or moral hazard occurred when the insured pleaded guilty to possession with intent to distribute marijuana, a crime. This was Erie Insurance Exchange versus the Commonwealth Insurance Department, a 1989 decision of a Pennsylvania appellate court. A trial court correctly determined that a loss was not covered by an insurance policy where the loss resulted from an increase in hazard within the knowledge and control of the insured. Now, every person concerned with underwriting insurance must remember that California, like most states, recognizes that an insurance company is entitled to determine for itself what risks it will accept, and therefore to know all the facts relevant to the applicant's condition. It has the unquestioned right to select those whom it will insure and to rely upon him who would be insured for such information as it desires as a basis for its determination, to the end that wise discrimination may be exercised in selecting its risks. This is Robinson versus Occidental Life, a decision in 1955 of the California Court of Appeal. And in L.A. Sound versus St. Paul Fire and Marine, a 2007 decision of the Court of Appeal, the court upheld the rescission of a policy of insurance for an innocent misrepresentation and concealment of material facts in an application for insurance. Underwriters must recognize that regardless of the covenant of good faith and fair dealing, insureds will sometimes lie to obtain insurance they could not obtain otherwise. For example, in Haley versus California Physician Services, a 2007 decision of the California Court of Appeal, the plaintiff's bar had coined post-loss underwriting to allow a case where an insurer proved misrepresentation to go to trial to determine if the misrepresentation on an HMO application for insurance was intentional. The case, although it refused to allow the insurer to rescind, and although couched in phrases of insurance, dealt with a different statutory scheme that governed health care payers and not insurers of property, casualty, or liability. The HMO statutes required an intentional misrepresentation to allow rescission, while property and casualty insurers can, by statute, rescind for an innocent misrepresentation or concealment of a material fact that was not intended. Much to the surprise of the lawyers who brought the case, when it went to trial, the insureds admitted that they had intentionally misrepresented facts, and their case was dismissed. Insurance underwriters must take a strong position when they find the insured has lied and spend the money, as did California Physician Service in Haley, which is the strongest method of determining a moral hazard created by an insured who is not truthful. You just can't accept a false, fraudulent insured. If that insured sues an insurer seeking indemnity on a policy that he or she obtained by lying, the insurer must defend itself through trial and with appeals up to the highest court available before making any payments to a person who has obtained a policy by a lie. And also, the insurer must report the lie, because it is a crime to lie on an application for insurance in now California and many other states. This video was adapted from my book, Zalma on Insurance Claims, Part 102, 3rd edition, which is available as a paperback and a Kindle book at Amazon.com. If you found this video to be useful or interesting, please pass it on to your colleagues. It's free. And please also subscribe to my YouTube channel and my Rumble channel, clicking on the like button or the Rumble button, depending on which service you use to view the videos. And please also subscribe to my blog and my Substack publications so that you can learn of future videos and blog postings. Thank you for your attention.